repetitive. Welcome back. It is 1:30 Eastern Time, and we are now in our third session in our Options Forum lineup today. And I'm pleased to announce we have a guest speaker today. I know many of you probably get bored of listening to the three or four of us repeatedly, so we brought in an experienced market professional, Ken Keating from the Options Industry Council, OIC. He's been in the business for decades. I was reading his bio, and he started at the P-Coast. Maybe some of you don't even know what the P-Coast is. That was the Pacific Stock Exchange, Pacific Coast Stock Exchange originally, and then just called the Pacific Exchange. And they had an options floor up in San Francisco, a stock floor down in L.A., and that's where Ken got his start. He then later went to the SIBO. And one of the roles he's held is something that we talked about a lot so far today, and we will continue to talk about, and that's the role of a market maker and the important role that a market maker plays. And Ken has done that professionally, so he brings that side of the market to all of us. And so I'm looking forward to our topic. Let me just make sure I show the disclosure slide. I want to make clear that you're listening to material from the Options Industry Council, not E-Trade. We are not affiliated. We're separate entities. I don't know where you are right now, but it is yellow and hazy here. The sun, you can almost look right at it because of the fires. I'm in the Northeast, and it's horrible here right now. So I hope that clears up. Ken, I don't know how that affects you, but welcome. It's all yours.
Well, thank you, Dave, and welcome everyone to today's presentation. My name is Ken Keating, and I'm a principal at OCC Investor Education as well as an Options Industry Council, and I am based in Chicago. I've been at OCC for well over 4 years now, but as Dave mentioned, before coming to OCC, I was a professional market maker. I was an options trader, both on floor and off floor. So I've also worn many different hats within the industry, but primarily as an options trader. So, and I'll be giving today's presentation on credit spread. So we're going to be looking at kind of the flip side of Sean's presentation earlier on debit spreads. So before we get started, I do have to mention we have our disclaimer. So options are rather complex vehicles and need to be properly understood before trading in a live account. So anybody who's looking to trade options should consider reading the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a digital copy, or you can always reach out to your broker or any exchange on which options are traded if you prefer a physical copy. In order to simplify the calculations used today, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies that I discuss here today are strictly for illustrative and educational purposes. So here are some of the trademarks and logos that you will see throughout the presentation. This is strictly for all the lawyers at OCC. A little bit about OIC. Who exactly is OIC? Well, the Options Industry Council, we are effectively the education arm of our parent company, OCC. So as many of you know, OCC is the Options Clearing Corporation and is the world's largest equity clearinghouse for exchange-listed options in the United States, as well as Foundation for Secure Markets in the United States. So we started out as a cooperative in 1992 to better educate the public both on the risks and the benefits of exchange-listed options. And we do that primarily through our website, optionseducation.org. There you'll find free online courses, podcast videos, as well as additional webinars like the one you're listening to right now. And our investor education desk can be reached at options@theocc.com with any and all of your options-related questions. Everyone on our desk is either a former market maker or broker, and we have well over 100 years of trading and brokerage experience on our team. So if you ever have a question related to options, you can always shoot us an email at options@theocc.com. We are, however, not financial advisors, so we can't talk to you about specific stocks or setups or where you should be investing your money in the options market. But if you have a question about strategy, theory, or say how corporate action can impact your options position, you can always reach out to us at that email address. All right, so here's a great little chart. This is annual options volume over the last 2 decades. So as you can see, the growth and trajectory of options trading has just skyrocketed. So as I was a market maker on the floor, I traded on the Pacific Stock Exchange and the CBOE. I left the CBOE right around 2000. And as you can see, right around 2000, we were clearing and settling about 2.8 million contracts a day, which at the time we thought was a lot of volume. And as you all well know, like 2001 was when the internet bubble officially burst, and it felt like we were doing a lot of volume. And that's when I left the floor and I gravitated off floor. But as you can see, volumes have just taken off. 2008, we had the financial crisis, the housing crisis. 2011, the sovereign debt crisis. 2020, we were dealing with COVID. 2021, rising interest rates, inflation, the war in Ukraine. 2022 was a record year for OCC, where we cleared and settled 10.3 billion contracts. So right now, I think last year we averaged 41.1 million contracts on an average daily basis. 2023, we're averaging 46.2 million contracts on a daily basis. So we're already looking to meet or exceed last year's record numbers. So certainly no lack of investors using the product to both hedge and speculate amidst all the volatility that we've been witnessing over the last 2 decades. Okay, here is today's presentation outline. So I'm going to be talking about credit spreads today. So as you listened to Sean earlier talk about debit spreads, I'm going to be talking about the flip side of the debit spread, which is known as a credit spread. So I'm going to be first talking about the basics of credit spreads, and then we'll examine the 2 types of credit spreads, the bear call spread as well as the bull put spread. And throughout the presentation, we'll be talking about strike selection. That's always an important topic, as well as assignment risk. Because anytime we are short options, whether they are outright or part of a spread, we always have assignment risk when we're talking about American-style options, which are the type of options that most stocks and ETFs trade on, are American-style options, meaning that they can be exercised on or before expiration at any time that the long holder chooses. And we'll get into some of the reasons why somebody might exercise early and some of the mitigating things you can do to avoid an unwanted assignment. Okay, so some spread basics in case you didn't listen to Sean's presentation. A spread simply involves, when we're talking about options, buying one option and then selling another option against it, or selling an option and buying an option against it. So they may be on the same or different underlying assets. They may have the same or different expiration dates if 2 or more options are involved. And they may have the same or different strike prices if 2 or more options involved. So there's many different types of spreads. We're going to be looking at vertical spreads today when we're talking about credit spreads, but there are vertical spreads, there are time spreads or calendar spreads, also known as horizontal spreads, and diagonal spreads. And how do we know which spread is which, whether we're talking about a vertical, calendar, or diagonal? Well, simply put, a vertical is when we when we buy or sell an option in the same month at one strike, and then buy or sell an option in the same month at a different strike. So in this case, a debit spread, a bull call spread would be an example here where we buy the 87.5 call in October and sell the 95 call against it. Okay, so it's a $7.5 call spread, and obviously we want the stock to go higher, so this spread appreciates in value. That would be an instance of a vertical spread. 2 different strikes, same month. Now, an example of a calendar spread or a time spread is when we involve the same strike but at different months. So a long time spread in this case would be if we bought the January 2024 100 call, in this case for $1.98, and we simultaneously sold the November 100 call at 78 cents. So that would be a net debit of $1.20. And we would put this spread on if we thought, well, we're near term in November, we're near term neutral to slightly bearish on the stock. We think the stock's just going to, trade right around the 100 strike. and not move very much. But then once this expires, we're looking for a bullish move in Jan. So ideally, we would like the November call to expire worthless, and then we would be left with the January 100 call, and hopefully the stock would make a big bullish move to the upside. So near term, we would be somewhat neutral to bearish. Further term, we are more bullish. Now, the last type of spread, a diagonal, involves 2 different months. It's kind of like a combination between a vertical and a calendar. So it's 2 different months, but at 2 different strikes. So in this case, a long vertical, or a diagonal, would consist of buying the January 2025 87.5 call, in this case for $12.64, and then selling the April 95 calls against it for $5.17. So obviously we're buying the more expensive strike, selling the less expensive strike, so we're putting that on for a net debit. That would cost us money. But once again, this is the idea that we think that the stock has a small likelihood of trading up to 95 by April. But then after April expires, we're looking for continued bullish move higher, which we would participate on by being long the January options here. Okay, but today we're going to be talking about vertical spreads. So once again, a vertical spread can involve either all calls or all puts, same expiration, different strikes. So when we buy a spread, as Sean alluded to at the earlier presentation, the investor purchases the more expensive strike and sells the less expensive strike. So in the case of a call spread, an investor would buy the 85 level call, for example, and sell the 90 call against it. And because the 85 call, in theory, would be trading for more than the 90 call, you're going to pay a net debit. It's going to cost you money, so that would be a debit spread. That would be an example of a bull call spread. A bear put spread would be buying, say, the 90 level put and selling the 85 against it. The 90 level put's going to be trading more than the 85 level put. So once again, we would be taking on a net debit and also looking for the shares to trade down, thus the name, the bear put spread. Now, a credit spread is just the opposite. That's when we are going to sell the more expensive strike and buy the less expensive strike. So we're going to be looking at 2 different credit spreads, the bear call and the bull put. But in this instance, in the case of calls, if we sold the 85 calls and bought the 90 level calls against them, now obviously we're taking on income. The 85 calls are trading for more than the 90 calls. That income is ours to keep. And obviously in this case, we would want the stock to close below 85 with both options expiring worthless at expiration, thus allowing us to keep the full credit from the spread that we sold. The bull put spread works just the opposite, where let's say we bought the 85 level puts and sold the 90 level puts. In that case, we would want both options to expire worthless. Hopefully the stock maybe closes at 95. In that case, both puts would technically expire worthless, and whatever credit that we received when we initiated that spread would be ours to keep. Now, the beauty of spreads is it allows you to define your maximum risk, maximum reward within the spread itself. So it allows you to trade with your eyes wide open. So anytime people are selling options, that can be rather risky. So in the case of buying options, you know what your risk is up front. It's whatever you paid for the option. So for a debit spread, any debit spread, your maximum risk is the debit that you paid for that spread. Your maximum reward is going to be the difference in strike less the debit paid. So if we're looking at a 100-110 call spread and we paid $3 for it, well, we know right up front that $3 is the most we can lose. And the difference in strike, in this case $10, less that $3 that we paid, which would be 10 minus 3 is 7. $7 is our maximum reward if both options ended up in the money. So we know up front what our defined maximum risk is and our maximum reward. Now, a credit spread is just the opposite. We know what our maximum reward is, The maximum reward is always going to be the net credit that we received for the spread when we sold it, and the maximum risk is the difference in strike less the credit received. So if we sell the 100-110 call spread for $3, the maximum reward that we can make is $3. The maximum risk is difference in strike, in this case $10 minus that $3, $7. So, and that is only within the spread itself. And this is a very important concept, and we'll get into this later in the presentation. But the defined risk nature of any spread only exists within the spread itself. So an exercise or an assignment may change the risk-reward parameters. So what do I mean by that? So let's just say I have the 100-110 call spread. I bought it for $3, and for whatever reason, I decide to exercise my 100 calls. Well, now I no longer have a spread on. I have a different position. I'm long 100 shares of stock from 100, and I'm short the 110 call against it. That's known as a covered call, and it has a completely different risk profile than the spread itself. So, the risk in a covered call position is all the way down to zero on the stock. It's in the long stock position. So once again, it's alluding to that idea that the defined risk nature of a spread only exists within the spread itself. All right, so let's look at some examples. So a bear call spread. So with the expectation that shares are neutral to maybe declining going forward, what can we do? Well, we can look to sell calls or sell stock short. Now, keep in mind, before I start, I want to mention, people always ask us, well, why would I do a bear call spread, credit spread versus a bear put spread? Okay, so why would I do a debit spread versus a credit spread? And this really alludes to what Dave was talking about earlier when he was going into implied volatility. And if you didn't listen to that presentation, I strongly suggest that you do, because, and I always tell people this, that the most crucial aspect of trading options, the most misunderstood but crucial aspect of trading options is understanding implied volatility. And it's one of those things that you have to have a grasp of implied volatility at any given time, and it's a moving target to understand the pricing level of options. So implied volatility is simply telling you how expensive or cheap option prices are at any given time. So typically, just like any product, stock, a commodity, options are no different. Traders like to buy low, sell high. So when option premiums are low, implied volatility is assumed to be very low. That's when you typically want to be a bigger buyer of options than a seller. When option prices are high or expensive, traders generally like to sell options, okay? Well, we know that selling options can be risky. In the case of calls, you have risk, unlimited risk to the upside, because in theory, a stock has no limit to how high it can go. And in the case of short puts, you have risk all the way down to zero. If the stock declares bankruptcy, you have risk from wherever you purchase that stock down to zero. So certainly selling options can be profitable, but it also carries tremendous amounts of risk. But this is where the spreads come in, where we can sell high implied volatility while mitigating our, limiting our risk. So what if all of a sudden we're bearish on a stock and, puts are too expensive? What can we do? Well, we could sell calls or we could sell stock short. Well, as I alluded to earlier, selling naked uncovered calls affords you income from the premium that you receive, but certainly you assume a lot of risk by doing so, by having unlimited upside risk, just like selling stock short. Okay, so to offset this risk of increasing share prices, the call writer can purchase an out-of-the-money call for protection and limit their upside risk. So once again, that idea of selling the more expensive strike and purchasing a higher strike as protection against it. So let's look at an example. So we have the DOLR, it's a fictitious financial services company, and we're bearish on the stock. It's missed earnings, it's lowered expectations, and we're looking to sell either stock short or sell calls. And we look and we determine that the implied volatility of the price of options is rather expensive. So we can sell stock short always, but that's always going to entail a lot of risk. There's no protection if the stock rallies, and it may require significant margin from your broker to do so. Now, we could also consider selling one call, but once again, naked calls offer no protection to the upside and may require significant margin through your broker. So what can we do? Well, we can buy a further out-of-the-money call against the call that we sold to reduce our upside risk and lower our margin requirement. So with DOLR currently trading for $50, we look at our options chain, and we see that we can sell the at-the-money 50-level calls at $1.65. At the same time, to protect ourselves, we look at and we see that we can buy the out-of-the-money 52.5 strike call for 65 cents. So we sold the at-the-money call for $1.65. We paid 65 cents for the out-of-the-money call. That's a net $1 credit, okay, or $100 per option, because remember, every option is the right to buy or sell 100 shares. It has a 100 multiplier. So when we sell that spread for $1, we're actually putting $100 in our pocket. And since we did it 5 times, we're going to collect $500 in premium. So what is our maximum gain, maximum risk? What's our margin? Our maximum gain, when we do a credit spread, is always what we sold that spread for. So in this case, $500. We sold 5 spreads at $1 a piece. That's 5 times 100. That's $500. That's the maximum gain that we can make on this position. Our maximum risk is the difference in strike. In this case, 52.5 minus 50. That's 2.5. That is our maximum risk. Okay, but remember, we took in $1 credit to put on this spread. So 2.5 minus $1 is $1.50. So $1.50 times 100 is 150. We did it 5 times. Our maximum risk is $750. Now our minimum margin is going to be our maximum risk. It's that $750. Now that may vary from broker to broker. You will have to speak to your broker because every broker sets their own margin requirements. But you will, but at a minimum, the margin is going to be $750. Now, what's the break even at on this position at expiration? Our break even is the net credit that we received, $1 plus the short strike. So we're short the 50 calls. We took in $1. Our break even is 51. So at expiration, if the stock's at 51, we would neither make money nor lose money on this position. Okay, so let's look at this bear call spread in graph form, because sometimes it's easier to wrap your head around this when you see it visually. So this is the bear call spread on a graph. There's our break even at 51. So since it's a bear call spread, ideally we want the stock to go down. So if the shares finish below 50, in theory, let's say the stock closes at 47.5 at expiration. Well, in theory, both the 50 and the 52.5 call have no value, and they would expire worthless, and we would keep the full dollar credit that we established this spread for. Now, what if the shares finish between 50 and 52.5? Well, if the shares finish between 50 and 52.5, the short call would get assigned. We'd get assigned on our short 50 call. Our 52.5 call would expire worthless, and that would result in a short stock position on Monday morning. So on Monday morning, if we did nothing with this position and we got assigned on our 50 call, we'd wake up with a short stock position, and if the shares were above 51 on Monday morning, we would be sitting on unrealized losses. And if the stock opened below 51, we would be sitting on unrealized gains. So, but ideally, before the at expiration, if the stock were between 50 and 52.5, we'd probably take some mitigating measures to at least cover our short 50 calls so we wouldn't be open to an unwanted assignment, knowing that. Now, worst case scenario, if the stock finishes above 52.5, both options would expire in the money. And if we did nothing, let's say stock closed at 55. If the stock closed at 55, we would be assigned on our short 50 call. We would exercise our 52.5 level call. In other words, we would buy stock at 52.5. We would sell stock at 50. That's a $2.50 loss. But remember, we took in that dollar credit, so that's going to offset that loss. So that's going to be a loss of net $1.50. But we did that spread 5 times. We would lose the maximum on this position, or $1.50 times 5, or $750. It would result in no stock position, but a maximum loss. Okay, so now, what if we are bullish on a particular stock and we have determined that the implied volatility is rather elevated? What can we do? Well, we can look to the bull put spread. So with an outlook that we are neutral to moderately bullish on a stock, well, an investor could, 1, sell puts outright or buy stock. Well, selling naked puts, which some people do in the form of cash secured puts, it offers you no downside protection except for the premium that you receive. Buying shares, depending on the stock, can be very capital intensive and once again doesn't provide you any protection if the shares go south. So if we go out and we sell a put because we're bullish, we can offset the risk of that put by buying a lower out of the money put against it and for protection and limiting our downside. So another hypothetical situation, we have BUBL. It's a fictitious $115 share soft drink company. And rather than buying 100 shares, which would cost us $11,500, we're going to look to sell puts. Well, obviously, selling puts outright carries a tremendous amount of risk, so we're going to put on what's known as a bull put spread. So we're going to look at our options chain, and we see that we can sell the 115 put and at the same time buy the out-of-the-money 110 strike put to provide us some protection. So we look at on our options chain, and we see that we can sell the 45-day 115 strike put at $2, and at the same time buy the 45-day 110 strike put for 70 cents. So we sold an option for $2. We paid 70 cents for the 110 puts. That's a net credit of 130 or 130. That's ours to keep. Now, what's our maximum gain? Well, once again, it's the amount that we sold the spread for, $1.30 times 100, the multiplier, that's 130. That's ours to keep. The maximum risk, your difference in strike, 115 minus 110, that's $5, minus that credit that we received, $1.30. So $5 minus $1.30 is $370. That is our maximum risk, $370. Our minimum margin is going to be the risk that we are assuming. That would be $370, but once again, this will vary from broker to broker. What's our break even at expiration on this position? Well, it would be our short put strike, 115, minus the net credit that we received, $1.30. So 115 minus 130, that gets us to 113.70. So at expiration, if the stock finishes at 113.70, we would neither make money nor lose money on this position. Okay, so let's look at the bull put spread in graph form. So here we are. We have our break even at 113.70. Now, ideally, we want the shares to go higher. Okay, we want both options to expire worthless. So let's say shares close at 120. In theory, both the 115 and 110 level put would expire worthless, and that would allow us to keep the full 130 credit that we sold the spread for. Now, if the shares finish between 110 and 115 and we do nothing, we would surely get assigned on our 115 put, meaning we would be buying stock at 115. Our 110 put would expire worthless, and we would wake up on Monday morning with a long stock position. So if the stock opened at 113, higher than 113.70, we'd be sitting on unrealized gains. And if the stock opened below 113.70, we would be sitting on unrealized losses. But once again, most traders who are trading spreads would close these spreads out, or at a minimum buy back their short options to mitigate against an unwanted assignment. Now, if the shares go against us and finish below the 110 level strike that we're long, let's say shares finish at 105, well, now both options are in the money. We would be assigned on our 115 put, and we would exercise our 110 put. In other words, we would buy stock at 115. We would sell stock at 110. That's a $5 loss. But remember, we took in $1.30 when we put on the spread. So $5 minus $1.30 is $3.70. That is our maximum loss on this position. We would have no stock position, but we would achieve the maximum loss. All right, so we always get questions at OCC, and once again, we're not financial advisors, so we really can't direct people on trades. But people always ask, well, what strike should I pick? What expirations should I pick? This is really a balance between risk and reward, and it's always going to be different from individual to an individual. Your idea of what's risky might be different from my idea of what's risky. What strike you decide to target is going to be different from what strike I might choose to target. So when we're looking at strikes, obviously in-the-money strikes offer greater reward because you're taking in a greater amount of premium. But if you're selling an in-the-money call, there's a greater likelihood of assignment. Okay, ideally, when we sell options, we want those options to expire worthless. So the forecast and timing is really paramount. So when we put on a credit spread, the long position, the long strike, is always purchased for protection in case our forecast is incorrect. So in the case of a bear credit call spread, the long strike, the out-of-the-money call, is the upper price range and our protection. In the case of a bull put spread, the lower strike put that we purchased defines the lower price range and is our protection to the downside. So, depending on what your forecast and risk tolerance is, will determine the width of the spread and what strikes you decide to choose. Now, people always ask, what's better, short-term versus long-term? Well, that's always going to be an individual choice as well. So as Dave was talking about earlier when he was talking about the Greeks, the Greek theta is your option sensitivity to time decay. So options have a finite life. Okay, at some point they're either, you buy or sell the option at expiration. It's either in the money or it's not. So time decay is a friend to option sellers, and it works against option buyers. So people who like to sell options typically target options that are anywhere from 30 to 45 days out. And why is that? Well, theta, or time decay, doesn't decay in a linear fashion. It decays more exponentially. So the closer and closer we get to expiration, the faster and faster those options decay. And even the week leading up to expiration, those options are really going to decay quite fast. So people who like to sell options typically like to target the 30 to 45 day options because that's when the slope of the decay starts getting a lot steeper. Now, you could choose to, sell longer dated options, and you're going to collect obviously higher amounts of premium for those longer dated options, but longer dated options also mean that there's more time for things to go wrong. Okay, you sell a 6-month option, yes, you're going to be taking in more premium, but you've got 6 months for, the stock to move against you as well. So once again, it's a balance between risk versus reward. Also, those longer dated options, say the 6-month options, they will decay, but not like the near-term options. So the longer dated options, as Dave alluded to, are more sensitive to changes in volatility or implied volatility changes than the shorter dated options. So, the longer dated options are more impacted by changes in volatility, where the shorter dated options are more impacted by time decay. So once again, the end game for people who like to sell options is you want those options to expire worthless and out of the money. That is the goal. All right, so now let's talk about assignment risk. So as I mentioned at the beginning of the presentation, anytime we're trading American-style options, we are at risk to assignment if the long holder chooses to exercise. Now, most options that trade within the U.S. are American-style options, meaning they can be exercised on or before expiration for whatever reason the holder wants. European-style options, which are typically traded on the big major indexes, the SPX, the Russell, the NASDAQ, those are European-style options that are cash settled that can only be exercised on expiration, at expiration. Whereas options that trade on stocks and ETFs that comprise the majority of the options that trade in the U.S. are American style. So why would somebody exercise an option early? Okay, well, to exercise an option early, there has to be an economic incentive to exercise an option early. Because if somebody who exercises an option early would forgo any time premium left in that option. So generally, the reason why somebody might exercise an option early is, and the biggest reason in the case of calls, is for a dividend. So let's just say I sold the 100 level call, stock was trading 95, and all of a sudden the stock rallies, goes against me, and now I'm short the 100 level call and stock's trading 110. And let's just say that there's a week to go till expiration. So the stock's $10 in the money. Maybe it's trading for $10.10. So it's got $10 of intrinsic value and 10 cents of time premium or extrinsic value. And let's just say stock is going ex-dividend tomorrow for 50 cents. So because that dividend of 50 cents is larger than the 10 cents of extrinsic value left in the option, that option is a strong candidate to be exercised early for the dividend. So somebody who's long that option is willing to exercise it early, give up 10 cents in time premium to capture a 50-cent dividend. Okay, so if you're somebody who likes to sell, let's say, covered calls on stocks or do credit spreads or debit spreads, you'll want to know this formula because it's a reason why somebody might exercise early is for a dividend. If that dividend is larger than the time premium left in the call. Another reason somebody might exercise a call early is in a hard to borrow situation. So what's a hard to borrow situation? Well, people who like to short sellers, like say hedge funds, people who bet against stocks, what they do is they sell stocks and indexes short. They sell them, they borrow them from their broker or their clearing firm. They sell them today with the hopes of buying them back at some future date at some time in the future at a lower price, and that the difference would be their net profit. But in order to do so, you have to borrow those shares from somebody who owns the shares. So in most securities, if there's a lot of people who own the stock, borrowing the stock's not an issue. You borrow the shares from your broker, you sell the stock, you deposit that stock in your account, and in theory, you would gain what's known as, slightly, you get a short rate, you would get paid by having that money sit in the account, you get paid a little interest on that money. If a lot of people are short the stock, let's just say, 90% of the outstanding float of the stock is sold short. That means a lot of people are betting against the stock. It may be what's known as hard to borrow. In other words, your broker can't borrow the shares to loan, or if they're willing to let you carry the short position, they're going to charge you what's known as a negative short rate or a premium to carry that short rate. So in the case of a hard to borrow, if the premium or the extrinsic value left in the option is less than whatever the negative short rate is, that option might be a candidate to be exercised early so that person who's holding it doesn't have to carry short stock. In other words, they're exercising their calls for the long stock. So that's just another reason why somebody might exercise early for a call. In the case of puts, somebody might decide to exercise a put if it's deep enough in the money to receive the short interest by being short the share. So if the extrinsic value left in the put is, say, 10 cents, but I could gain 40 cents by being short the stock, I might choose to exercise a deep in the money put. Now, interest rates have been rising lately, And I remember when I was trading on the floor in Chicago in the late 90s during the internet bubble, we had a lot of very high dollar stocks, and interest rates were considerably higher. So if puts were deep enough in the money, there was an incentive there to exercise early so to capture that short rate or not pay interest on the long stock you're holding. So typically it happens when stocks, when the interest rates are a lot higher. So that's another reason why somebody might exercise early in the case of puts. Now let's look at some of the risks of the bear call credit spread. Now, and this also applies to a debit spread as well. So once again, this is where that idea of defined risk only existing within the spread itself is really rings true. So let's just say we put on a bear call credit spread. Using the example earlier, we sold the 50 level call. We bought the 52.5 level call against it as protection. Stock closed at 49 at expiration. And we're dancing, we're happy, we think, okay, both options are expiring worthless, I'm going to keep this dollar credit. Well, let's just say some bullish news comes out after hours, and now the stock's trading 55. Well, even though the stock closed at $49, we still have assignment risk from being short this 50 level call. So somebody who is long this call could choose to exercise if they get their exercise notice into their broker within their broker's exercise cutoff threshold. So typically options that are, as Dave mentioned earlier, if they're a penny more in the money, they get automatically exercised. It's a process known as X by X processing, and it's a process that OCC extends to our member firms. But brokers have a separate exercise threshold. So they're, your broker might have a different exercise threshold from what OCC has. So once again, you want to check with your broker as to what their exercise threshold is. But once again, if somebody decides to exercise this 50 level call, you can still get a sign. So if you didn't see the news, if you turn off your screen and you think you're just going to make this dollar credit, and then you wake up on Monday morning and you find yourself assigned on this short 50 level call. Okay, and you ask yourself, well, what happened? Well, what happened is somebody exercised because they saw the stock trading 55 in the aftermarket. They probably exercised their 50 call, sold some stock against it, and locked in a profit, and you woke up on Monday morning short stock. So in order to mitigate against this, you would either, one, buy back your short options at a minimum at expiration, on or before expiration to manage your risk, or just close the spread. And, some people would look at this and say, well, stock's closing at 49. Why would I buy back this worthless 50 level call for a few pennies or a nickel where, 99 times out of 100, yeah, it's probably going to expire worthless. But it's that one time in 100 where all of a sudden news pushes stock to 55, you get a sign, and you wish you spent that nickel or a few pennies to buy back this short option. Once you buy back this short option, you no longer have assignment risk, okay? So just something to keep in mind. So if you let's say you did see this news and stock's trading 55, well, now you would have to think, okay, there's a strong likelihood I'm going to get a sign on this short 50 call. I could exercise my 52.5 level call to cover my risk. So you would have to call your broker and manually exercise this 52.5 level call to mitigate against your risk, assuming that you would get a sign on this 50 level call. Now, you wouldn't know you got a sign on this 50 level call until Monday morning. So once again, what if you exercise your 52.5 level call thinking you're going to get a sign on your 50 level call, and then the stock drops back down to 49 in the aftermarket, and now you bought stock at 52.5 and stock is trading lower on Monday morning. So there's all kinds of headaches that can be involved with these spreads at expiration if you don't cover your short options. So there's an old saying on the trading floor where traders used to say, when in doubt, just close them out. So we were always looking to cover our short exposure because it's that one time in 100 where something happens. Stocks do move in the aftermarket, and sometimes you wish you covered those short options for a few pennies. All right, so now let's look at the flip side. Let's just say we put on the bull put credit spread. Stock at expiration closed at 116. We sold the 115, 110 bull put spread for $1.30. Only in the aftermarket, some bad news comes out. Now the stock drops to 105. Okay, so we're thinking that we were going to keep this $1.30 credit because both options expired worthless. And now, with the stock trading 105 in the aftermarket, we still have risk of being assigned on this short 115 level put. So, if we do nothing, we could find ourselves on Monday morning with a long stock position from 115. Okay, so once again, pointing to the idea that when you're short options, it's always a good idea to close them out so you mitigate against this kind of situation. I can't talk about the stock, but this happened a few years ago. There was a very high dollar stock, and some bad news came out, and people were short a lot of these bull put spreads, and the stock dropped $100 in the post market, and people didn't see the news, and they woke up on Monday morning and they got a sign on their out of the money puts. And puts got exercised that were $40, $50 out of the money. And people woke up on Monday morning, stock down 100, they lost tons of money. I know one notable investor lost, I think it was $750,000 because he didn't cover his risk exposure. So once again, it really gets back to that idea that the defined risk nature of a spread only exists within the spread itself. And an exercise and assignment may change the risk-reward parameters. So once again, spreads are not set it and forget it strategies. You're always going to be wanting to monitor them. And at a minimum, it's always a good idea to cover your short contract exposure. So how can we manage this position if the market moves against us? So if we have the bear call spread on, and we're betting that the market's going to go down, but instead the market goes up. Well, what can we do? If the market goes up or implied volatility goes higher, in other words, option prices go higher, that's going to impact us negatively. So because it would lead to increasing prices. So what can we do? Well, we could what's known as roll the position. We could close out of our bear call spread and roll the entire structure up to a higher strike. Or we could roll the entire structure out into higher strikes. So we could either roll the position up, or we could roll it up and out. So, if we're short the 110, 100 level call spread, now stock's trading 105, and we think it has more upside, maybe we just, buy back that 100 level call, sell out our 110, and roll it up to the, the 110 or 105, 115 spread, something like that. So just roll the entire structure higher. Now, we can always just close out the position. That's always an option and live to fight another day. Or if maybe the stock is ripping on a short squeeze and we think it's temporary, we can just hold the position hoping the stock is going to pull back and maybe trade below our short strike and expire worthless. Once again, this is all going to be dependent upon your outlook on the shares and your individual risk tolerance. But, within the spread itself, up front what your risk is. It's defined within the spread. So at a minimum, what your risk is, assuming you don't exercise or get assigned on any of the positions. Now, the bull put spread, obviously, we want the stock to go higher with both options expiring worthless. And if the market goes down or implied volatility increases, that's going to lead to increasing prices. Same situation. What can we do? Well, we could roll the entire position down within the same month. We could close the near-term position and roll it down and out into a different month, or we could just close the position entirely or just hold it. So once again, it's all going to come back to what your outlook on the shares are. Spreads are not set it and forget it strategies. You're going to want to constantly monitor them, and obviously news is going to affect your forecast. market dynamics are going to affect your forecast. Anything, the market's always changing. So just know that you'll want to manage the position, especially at expiration on those short strikes. All right, so here is some of our information. So if you want to reach out to us at OIC, here is that information. You can contact us, check out our learning courses, download podcasts, additional videos. And if you want to reach out to us, here's our email address, options@theocc.com. We also have a YouTube channel, which we archive many of our past webinar presentations. So if there's a subject you want to study more about, whether it's implied volatility or butterflies or calendar spreads or you name it, we've done multiple videos on just about any subject that you can think of. And once again, this is it's all free, and it's a channel dedicated just to option content. So I know we have a little time left over, so I'm going to bring back Dave. And I know I've been seeing some questions come up, but maybe we can entertain some live Q&A with the time remaining.
Definitely. The topic that's just come up through several questions here, I just want to sort of address and put a bow on it. People are confused about the 4 p.m. close Eastern time, exercising, and then the stock trading in extended hours. So one of the things I think that trips people up is technically the option expires on Saturday. It stops trading at 4 p.m., and then the process of exercise and assignment occurs. It's a limited window. You've only got a little bit of time to deal with that, but if the stock is trading in extended hours, someone can make a decision to exercise at that point. The option isn't trading. The stock is trading, and it still is exercisable during that brief period. That's something that we've seen it happen here. It's not, it doesn't happen a lot, but we've certainly seen it.
Yeah, it is a risk you have to keep in mind. And like I said, for OCC, for our member firms, we require that they get their exercise notices into the exchanges by 90 minutes after the New York close. In other words, 5:30 p.m. Eastern Standard Time. Now, some brokers, allow you that 90-minute window if you want to exercise an option that closed out of the money. Or on the flip side, if you don't want to, if you're long and in the money call and all of a sudden the stock drops, you could file a contra exercise notice to not exercise an in the money contract. But you would have to do so within your broker's cutoff time, and it varies from broker to broker. Some brokers give you the 90-minute window. Some are as little as 10 or 15 minutes. So once again, you want to check with your broker. But there's different windows, and depending on who your broker is and who you clear. So it's a really important concept that sometimes trips people up.
Yeah, and it really underscores your discussion about spreads aren't set it and forget it. You do have to manage it, especially as expiration approaches. Really,
absolutely,
really vital, no doubt. I thought the conversation about the things that cause early exercise was fascinating. Frankly, I've never talked about comparing the hard to borrow cost in those types of things. But one of the things that we used to see a lot of, but doesn't happen much now because there aren't very many mergers, but when there's a reorg going on and a stock's going to become something else, a spin-off of some sort, or you can see early exercises in those situations too. Let me answer Mark's question here. This came up earlier, and I was trying to type a question, but maybe it was getting too wordy. When we were doing an earlier spread, I believe it was the call spread, and you said when selling, actually I think it was the put spread, when selling one leg at 50, 25,000 will be held out of the account until the end of the trade. Is that correct? So we're mixing things up here a little bit. If you sell a put and and it's not covered by anything, then one of two things happens. You either become cash secured, and in that case, yes, 500 shares at 50 would be $25,000 would be encumbered in your account. You wouldn't be allowed to spend it. You wouldn't be allowed to use it as buying power. But when you do a spread, it flips it around, and your requirement is just the max loss, which, again, we illustrated on several of the slides there. So, Mark, I'm guessing you answered that question early, that you probably gathered that from the rest of the conversation. But if you're selling puts uncovered, if you do them cash secured, it's the whole value of if you're assigned If you do it on margin, there's a different calculation for that. And by the way, my colleagues have put in a note here about our cutoffs. So, and this is from the website. Exercise requests are only accepted online between 9:30 a.m. and 3:55 p.m. Monday through Thursday, 9:30 to 5 p.m. on Friday. So that's typically expiration date. And then if there's a half-day market, there are some terms there, but that's not really very relevant. So basically, expiration Friday, you have an hour after the market closes to give us exercise instructions, and that can be done in your brokerage account. There's a link in your positions page there, or you can do it by calling us. I think we're probably pretty caught up on questions. Let me just get some of my colleagues have been reading these more actively than me. Anybody want to jump in here?
Yeah, I'll jump in. This is Sean. So,
hi, Sean.
There's, from a real world situation, and I hope everybody picked up on it, when in doubt, close it out. There's another situation that I don't want to like make this Pandora's box even more open. But there is an SPX option that technically stops trading Thursday, but to determine if it's in the money or out the money won't happen until Friday morning. If you don't like, so people Thursday are like, woohoo, I won, I'm rocking the world. And then lo and behold, the market opens different than it closed. We all know that happens, especially with, international events being so transparent, speed of light stuff. So if someone's going to trade those, which I'm not suggesting that you would want to, but this is sort of old school option trading, close that thing out Thursday, and your market maker becomes your friend there, because the market maker is going to go ahead and let you close that trade out and be done with the trade, so you can buy your friends at the bar a drink because you've locked in that profit, or you've suffered that loss and they can buy you a drink. It's the same situation. If you're in doubt, close it out. And I've seen so many people go, yeah, I'm not giving that person a nickel. They're just picking my pocket. Give them a nickel. Be done with the trade. Close it out. Because we can get into all sorts of minutiae, like, well, what happens if I've bought a 3-year option on Twitter and then it goes private? Let's not get into these 3 standard deviation type situations. But what Ken is doing, and I appreciate it because it is a fun discussion, is what happens after the market closes and maybe the stock pops. Or let's go really esoteric and just assume that another retail trader says, I don't know, I just got a good feeling about this stock, even though it's out the money and there is no news. I think I'm feeling super lucky, so I'm going to exercise. There's no fiduciary rationale behind it whatsoever, but the person that has the right to do something has a right to do it even if it doesn't make sense. And I've only seen this one time in my career where a woman called and said, I want to exercise my Disney calls. And I'm like, why do you want to do that? It makes no sense. You'd be better waiting to buy it on Monday. Because I want to do it. Fine, I'll put in the order. We'll do it. Whoever gets assigned this on the other end will be scratching their head. Why did somebody just give me free money? I don't know, but they did. So anyway, I'm way off in a tangent, but there you go.
Yeah. I mean, anybody who owns that option technically still owns the right to exercise it, whether that makes sense or not. But one of the things that you were alluding to earlier, especially with index products, if you're somebody who likes to trade, let's say SPX, okay, it's a big cash-settled index, and you look on Thursday at expiration, and you're looking at your screen, you're saying, God, it's like these things are going to close in 10 seconds. Why are these out-of-the-money calls trading for $1? A couple strikes away or 5 strikes away. Why are they trading for $1 or $1.50? It's because of that gap risk, because the SPX doesn't close technically on Thursday. Yeah, the options close on Thursday, but the price that they use for settlement is called the SET price. It's based on where the S&P 500, all the 500 components, open on Friday morning. So, if news comes out, some bullish geopolitical news comes out and SPU's open lock limit, that's, it's going to settle a lot.
Wow. So there's going to be a lot of people taking a lot of fiber, we'll just put it that way, and trying to calm their nerves a little bit. Hey, Steve, who is also a former residential market maker, Steve and I are doing the office hour tomorrow. Really fun conversations. We love getting into the weeds like this. because it's fun for us, but it's pretty rare that these kinds of things happen. They kind of become some of these, as Ken and I are talking about, these like, let me tell you how crazy it can really get. But mostly, you're not going to be, these kinds of situations happen. With after-hours trading, it's becoming a little bit more common, but I don't think it's something you really need to necessarily focus on too much. But nonetheless, it's fun. We can continue to have those conversations at office hours, so we'd love to see you there. I'll back up here. I know we got a little bit longer break now to give everybody a chance to get some food in.
I'm about to cut you off, Sean.
Yeah, but I know
we need to move on here. Yeah, just to reiterate what Sean was saying, tomorrow we're having a session that we are calling Office Hours. It's at 12 Eastern time tomorrow. If you go to etrade.com/events, you can register for it. It's going to be an open-ended discussion. Office hours like your professor was. He would be available for you to come in and, bring your textbook and say, what about this chapter? Well, that's what we're going to do tomorrow. So a lot of the stuff that we'll lay out today, we'll be able to get to in a little more detail there. One last thing. There was a question from David in here. Is there a trick to quickly understand a type of complex trade other than just being active in options? I have to think to myself, okay, I'm short this call, long this, et cetera. And by the way, David, we get it. The one thing I would say is go to etrade.com and then go to options and click the tab for strategies. And what you will see is each option strategy described, talks about the point of view you should have, talks about risk and reward, but most importantly, it graphs the outcomes. It's called a P&L chart, also sometimes called a hockey stick chart. We had an example of that. Ken had one in here. Using those gives you a visual of the risk and reward outcomes. And if you study hard and memorize those, you'll be well on your way to learning the stuff you're talking about there. So good stuff. Anyway, we do have a 30-minute break here now, folks. So we've been doing 15-minute breaks, but we're going to pause for a little bit. Give us a chance to maybe have something resembling lunch. And we'll be back with a couple of hands-on sessions. Next one's going to be Steve and I using Power E-Trade, showing the spread-related functions. And then Rick's going to do one on mobile. And then I believe our last session of the day is Rick using charts for strike selection, a very important one. Ken, thanks so much. Really enjoyed it. Really good deck. I think we're going to get good feedback on this. Sean, thanks for your help, of course. And stick with us, folks. We'll be going again at 3 p.m. Eastern. Take care.
Thanks, guys.